Is this working? Okay, super. Thank you. Good morning, everyone. Great to see a nice crowd out here when it's downpouring and kind of disgusting outside. For virtual folks, you made maybe the right choice staying home today. Great to meet all of you. My name is Greg Montemuro. I lead ops in the program at the DCU FinTech Innovation Center. We're a nonprofit zero-fee FinTech accelerator right across the street from South Station. I've been there for 5 years. We work with early stage FinTech startups, but more about me later. I would love quickly to have my virtual panelists, it's so awkward figuring out which way to look here, introduce themselves because I couldn't do them really true justice here. So I guess we want to start with Sarah. Could you give a quick introduction for yourself?
Sure. Yeah, great to see all of you. Looking at the video right now, I can see some people in attendance live, and then I'm sure we have some people joining virtually as well. So appreciate you guys joining this morning. My name's Sarah Hovde. I am the head of investor relations at BankTech Ventures. We are a venture capital fund focused, as the name's in banking. We're all fully remote. I'm currently out here in Vail, Colorado. I'd say it's kind of drizzly out here too, but that's good because that means that ski season is coming, which we all love to hear. But yeah, excited to be here with all of you today and, delve into our experience at BankTech, my experience with fundraising. And yeah, Greg, thanks for having us. This is really fun.
Of course. Thanks, Sarah. And I also didn't mention what the session was even titled. It's how to approach friends and family funding. It's a super awkward conversation, interactions and all that. So we'll be kind of discussing where do you start, the boundaries around that, etc. But I'll throw it to Jay now if you want to quickly introduce yourself, Jay.
Yeah, hi, I'm Jay. I'm a private equity investor at BC Partners. BC Partners is a European private equity fund with offices in London, Hamburg, Paris, and New York. And we manage around 40 billion in AUM with our latest fund, our private equity fund, being 7 billion euros. Before this, I was a private equity investor at Lindsay Goldberg, which is a $15 billion AUM fund, which latest fund was 3.5 billion, investing across all sectors. And BC invests primarily in healthcare, TMT, software, and business services. Before that, I was an investment banking analyst. And then before that, I was actually a founder that was YC funded, at a startup called Mutual Bloom, which was a personal fitness startup, matching coaches with athletes, which was started with my best friend. And I currently also do outsource CFO roles for startups. So,
super. Thank you, Jay. And last but not least, Nat.
Yeah, thanks, Greg. Nat Clarkson. I'm a partner with BankTech Ventures. We're in, seed plus Series A fintech investor, although we can do later stage and earlier stage investments as well. Before that, I was a managing partner at another VC fund called CFE Ventures, where we did about 94 investments in seed and pre-seed stage companies in fintech. Was an investment banker prior to that, and for a very hot minute was an attorney before I decided that was not for me. Family business, got caught up.
Reformed attorney, thankfully.
Yeah.
Super. Thanks, Nat. So I kind of want the session, especially for the folks in person, to be interactive. So feel free to throw your hand up if you have a question. We can kind of keep it casual. If you're virtual, use the chat function. That's on you. So real quick, just quick question for the in-person folks. Has anyone here raised capital before for a startup? Has anyone here done that before? Okay, a good number of hands. You can just shout it out. What was that process like? Yeah. Back right. Interesting. That's what I was going for today. Interesting time in your life to have to raise capital, especially when you have to keep raising capital. And thankfully, kind of with my background working with early stage companies, and then kind of our esteemed panelists background working with from young to old companies, we have a good wealth of experience here, kind of working with these interesting scenarios. So I guess, Sarah, where do you start when you're thinking about raising money? Especially from friends and family. Where does that conversation begin? How do I bring that up to my uncle? I'm like, hey, Uncle Charles, I'd love to. I'm starting something really cool. I'm starting something new. Can I have $20,000? Where do you begin?
Yeah. So, I guess from my experience, I've only fundraised on behalf of our BankTech Ventures fund. So, being a venture capital fund, we're really fundraising just based off an idea of, how we are going to go and invest the money that we're receiving from our limited partners. So what was interesting is we didn't even have a product to show yet. It really was all conceptual. The whole fund is based off of this closed loop ecosystem. So starting there, I mean, it's a little bit out there, especially because of the people who we're going to and fundraising from are mostly bankers. So I come from a family who, is involved in banking. And when we went out originally to what I'll call our friends and family round, really, who you hope would be the low hanging fruit, you have to go in there and first of all, separate the fact that, you're my uncle, you're my brother-in-law, you're somebody who I've known for the last 15 years. And they have this idea of you that you're just a young kid, very green, fresh out of college, or a few years ago. And they're like, okay, well, why should I listen to you? So, I'd first and foremost say, come as prepared as possible. Have your entire presentation, well, at least for me, I'm not as good at just winging it conceptually, but do yourself a favor, have a presentation deck ready, show that you're legitimate. It's fun to start up these conversations, maybe over coffee or cocktails, with some of your closest friends and family. But I would say once you're starting to go out to people who, uncles, cousins, maybe a little bit of that degree of removal, I mean, just do yourself a favor and really lock down your pitch. And, these are people who you love, and it can be more of a conversational type fundraising and sales pitch to them. But I don't know, I would say just know what you're fundraising for, have a presentation deck ready, have some of the standard Q&A ready, come and show that you're legit. So that's where I'm going to start.
All right, super. Thanks, Sarah. Jay, for your YC-backed company, did you guys kind of pursue the friends and family route at all?
So for our company, basically, we didn't pursue that at all. We were actually able to raise seed funding from institutional investors. But that aside, I started my startup with a close friend of mine. And actually, what ended up happening was that, we had a bit of a falling out because I wasn't willing to actually drop out of college to work on my startup. So at the time, I was attending U Chicago. And I wasn't really willing to do that. So it ended up kind of falling apart. So there's an important thing to note here is that if you're trying to raise money from friends and family, you also have to come in with the expectation that the relationship can kind of fray, right? And be prepared for that. So
I get not to deviate, I guess, a little bit from the topic since we just started, but
sorry.
I mean,
Yeah.
when you're building a company, from what the founders I've worked with, you're kind of marrying someone, at least until one of you either exits or gets fired. What was that like, Jay? I mean, it's basically your family you were working with, even if it wasn't your family, your founder. So I guess, how did that relationship kind of work out, and what does it look like now, if not great?
Yeah, so I would say that the relationship between your founder, right, is incredibly important and something that you really need to pay attention to and focus on. And this also goes for fundraising, right? Like if you're raising money from friends and family, they're going to have certain value expectations tied to that, which makes it kind of, difficult, right? So you want to make sure that you're handling that situation devoid of any emotion that you have towards that family member, because things can get emotional and really intense, right? And in addition to that, right, the relationship that you have with that person might just forever be frayed, right? Which is something that you're going to have to go in knowing, right? And you have to have that much conviction in your company if you're willing to raise money in that way, right? So
Yeah.
there's obviously things you need to balance.
Yeah, and kind of building off that, Sarah or Nat, up to you, which one of you wants to take this one. You have the conviction to work on a company, you have the conviction to raise money, and you have the conviction to go to your friends and family, which I think is like an extra level bar, which is like, yes, I want to get my blood relatives involved here. How do you set it up where you're not having your uncle call you on a Thursday, right? Unlike, the other investors who should be waiting for, the Q3 update. And they're like, oh, hey, Sarah, Nat, how you doing? And how's that company? Because at the end of the day, unless you have a super wealthy family, which I'm assuming the majority of folks here don't have, if your uncle, your aunt is investing in your startup, it's probably a large portion of their net worth, especially their liquid net worth. And so, angel investor and then invest in a company, okay, you know, they might care, but it might be like 5% of their net worth. They can be like, you know, Greg, you're doing all right. I'll chicken on you every few months. But if it's your family, they're like, hey, I put in like 70% of my assets because I believe in you. I love you. So I guess, how do you set those expectations and not let them overstep boundaries?
Yeah, so Nat, here, I'm going to start with this really quickly, but I would say in my role as investor relations as well. So, you know, I'm in charge of the communication for our fund. I'm doing outreach as it relates to, you know, eventually capital gains, distributions for our investments, you know, right now, quarterly reporting, webinars, etc. So I am the person who people are calling when they want something. And, you know, I'm always happy to answer, but especially when it's a family member, I'll first say that, you know, they might reach out under the guise of like, oh, how was your weekend? And like, you know, I heard you ran a race, you know, what was your time, etc. And now like, well, I see in my latest quarterly statement that like we had this, you know, operating expense, blah, blah, blah. And so you don't always know what they're calling for, but then they'll slide it in there, updates on the fund, how's fundraising going, you know, how are the investments to date. So they, unfortunately, you know, you're not going to not answer a call from your aunt or uncle because you're scared that they're going to ask you about the company you're running. And, you know, obviously you have to take all those calls and emails. And it really is just, you know, stay on top, you know, if you're the founder, stay on top of your own company, you know, information, updates, health, etc. And I would say it's okay to say like, you know, even if this isn't true, like I am scrambling right now, but I'd love to set up a call with you tomorrow. We can really talk through it. You know, you can't avoid them entirely. And I would say, you know, so take that call. They're your family member, they're your friend, you know, they might slide it in, also just checking in on your life, like any good family or friend will. But, you know, maybe broach the topic a little bit and then just say, I would actually love to do a Zoom call with you tomorrow, Friday, you know, early next week, and really run you through all of this. And like any family member, you know, they might go with it, they might push back. I think ultimately you can sort of steer them towards that direction of a little bit of separation between church and state. You know, maybe if they're calling you at 10 o'clock at night or 8 o'clock at night over dinner, just say like, it's so good catching up with you, but let's actually talk about this during the day because I want to make sure that I'm bringing forth, you know, my best materials, my best answer for you. But again, like you're going to get caught off guard because, you know, one day they're going to call asking what's up with your dog. And the next day they're going to call what's up with, you know, last quarter financials, etc. So that's my take. Matt?
Yeah, no, all good advice there. I would say before you even have to face that, think about it up front. Think about your options, who you're going to go to. Try to avoid people who are going to be giving feedback, which is not that useful, and that are going to be overly involved. Try to be, you know, going to people who also can afford to lose the money, can afford to invest. Don't go to somebody who, you know, they're going to put in 70% of their net earnings. I don't care how good your business idea is. There's risks to it. Put in your own money. And then, as has been said a number of other times, make sure you document everything and make sure everybody is clear on who is in what role. If you're not in a board position, you're an investor, you're an investor. You get investor rights. Make sure that that is clearly documented and communicated up front. Give everybody fair value up front. We can talk about how you might want to think about doing that in various structures, but don't try to get fancy or anything. On the other hand, don't over dilute your equity. So all this is to say, really give it some thought, not only in terms of how you're going to raise, but who you're going to raise from, and, you know, go into it with that type of strategy. So you're going to the right people who can afford to make the loss, who can afford to invest, that will not be one of those problem people. I think the issue with Jay is, in one issue is that was a co-founder. It's very difficult when you have a co-founder versus a family investor, the uncle we've been talking about. Those are fundamentally different positions, and you should make sure that they stay fundamentally different positions. And you can do that through a variety of ways. And then there's always ways, you know, if it does go poorly down the road, you can always part ways. You can have buyouts. You can buy people out either from the company or new investors coming in when that's appropriate. And hopefully it's a win-win when some of those friends and family may want to exit the Series C, Series A, or they become just a less of a potential drag on the business as later more institutional investors come in. They're going to have a little bit more of a say, and those early investors get diluted down. And hopefully you won't be in that situation, but if you do, you can manage it, or if you are in that situation, you can manage it. But the best thing to do is just make sure you don't get into it up front.
Yeah. And then one thing to add, have a good lawyer. It's very important. Have a good lawyer, because Nat's hitting on that as well. Having a good third-party advisor is really useful. So.
Yeah, and that's just to double down on that. Not only a good lawyer, because you want to make sure you do everything right from a securities law perspective, but also just from an organizational and governance perspective. If it's your own thing, you might want to do an LLC. But if you're going to raise future money, you might want to do, most businesses use a C Corp structure. And you can always convert, but it's a little bit problematic down the road. And then that entails a certain amount of governance, what you have to deliver, when you have to deliver it, who you have to deliver it to, your fiduciary duties, who's on a board, whether or not you have a board, if it's a member managed LLC versus a manager managed LLC, or a C Corp, which generally has a board, which has governance and control. So thinking through all of that, working with your attorney, it'll help you because you'll have the backing of the documentation and everything up front that you'll be able to rely on, and everyone will just know what they're getting into, which is by far the best thing you can do up front.
Yeah, and to kind of build off that, Nat, this is not legal advice, so everything you're saying, the footnote, is not legal advice.
Without
no way. I guess where would you start with governance, right? Because I feel like that's a big question a lot of folks have, which is, where do I even begin? I have a family member that's like, yeah, I'd love to give you $10,000, and another friend that's like, I'd love to give you $5,000. Okay. Do I just take the money via PayPal, right? Like, what does that look like? What do I set up? Is it a C Corp? Is it an LLC? Where do I begin?
Yeah. Brown paper bags by the bridge. That's where you do your handoff. No. I think as Jay is mentioning this as well, get your corporate structure set up based on what you want to do first and upfront. And then you're going to start and make sure you maintain all of the subject parts of that, which would, in this case, would be your cap table, and you have to have a bank account. So then when the money comes in, it's tracked. You exchange through, usually an online platform for cap table management. It could be Cardash, it could be ShareWorks, could be, you don't have to use one of those. And then, you issue the shares or the convertible note or whatever it may be. And we could talk about the different structures you may want to use in this early stage. You can do an equity raise. That's a little harder because it's hard to get a valuation for the business at this time. People who were starting a business obviously think it's a pretty good deal. But others who may be outside may have a little bit of a different risk tolerance. So you can think about something like a convertible note where you don't have to put a value up front. And that also provides those investors with a little bit higher in the capital structure because it's debt versus equity. They get some liquidation preference if it comes out. If the business does wind down, some other things. It also, and you don't have to set a pure valuation. You set typically a cap and a discount. You do a safe, another one that's very popular these days with a cap and a discount or something like that. So you allow people to get involved. These are known structures. You're not being cute or coming up with something esoteric. There's a lot of legal background with these, and then it kind of helps bridge the gap on who gets what, when, where, and how.
Yeah, perfect. Thanks, Nat. And I'm going to throw it to you, Jay. I know you didn't raise capital from friends or family, but you raised from institutional investors. Where did you start with saying my company is worth this much, right? It's an idea. Maybe we have some traction. Maybe we don't. All right. Is it a $2 million business? Is it $30 million? I guess, where did you begin and kind of where did you end up?
So it depends on how big your dream is, right? Which is also something funny to say, but if you really believe that you have high conviction that you can deliver to your LPs a future $1 trillion business, that's your prerogative, right? So it's also important when you construct thing like mindset on valuation, what you want the company to be in the future. I know that's like a really big question, a really early question to ask yourself at this stage, right? but you have to come up with that, because otherwise you're not going to be presenting an honest story to your LPs, whether they're friends, family, or institutional investors, right? You want to be honest about where you see this company going in the future, what your goals are, right? For example, there are tons of startups that are not really startups, like, for example, sponsor owned assets, right? There are people who buy car washes in like Florida and then buy them for like $5 million a piece, roll them up, and then sell them for like $600 million. That is a startup, right? Even though in your guys' mind, that's not a typical idea for a startup. It is a startup, right? Because they're starting something, they're starting a small business and making it into a big business. And their goal is to sell that big business in the future to a sponsor like BC Partners for a large premium, right? So it's important to have those goals in mind. Now, I think the second part to your question is like, how do you get from like friends and family to the institutional capital phase? I know a lot of people feel challenged, especially when they hear from VCs like, oh yeah, we're interested, but we're going to pass for now, especially in this fundraising environment, right? I would say that it's really important to make good connections and constantly give visibility to the VCs that you want in your cap stack, and constantly follow up with them and almost develop a personal working relationship. That's an odd phrasing, but the reason why I say that is because if you really want someone involved, right, and want their expertise, that comes off as much better than you say going like, oh, I want $5 million, right? Um, so I honestly think that approach is the way that you kind of build that relationship over time and kind of drag it into the friends and family aspect where you develop that personal working relationship.
And building off of that, I'm going to throw it to you, Sarah. Wait, real quick. Does anyone in the audience have questions before we continue? All right, we're feeling shy. Perfect. Sarah, realistically, I'm raising a friends and family round. I might have an institutional investor involved. I raised a $600,000 pre-seed round. $500,000 comes from an unnamed venture firm. I don't think I'm allowed to name any of them right now. And 50 grand comes from my dad. 20 grand comes from my aunt, and then 30 grand comes from my friend. Realistically, the most important person in my life right now is the institutional investor that put in $500,000. How do you manage the power dynamics of not making, someone that's put in money not feel almost small?
So, okay, well, I guess in a sense, the institutional investor may have put in the most amount of money, but they're also an institutional investor. You don't have that emotional, familiar relationship with them. And honestly, the institutional investor probably has their own set of, diligence, requirements around reporting, et cetera. So if you're kind of hitting that, I don't want to call it the bare minimum, give them plenty of information, make sure that all of your reporting to them, your conversations with them are timely. You're doing very, active outreach to them. So be proactive with your institutional investor. Don't wait until they're asking you for everything. But at the same time, they kind of sit in their own silo. So they actually might not require as much information or effort as your family and friends rounds, because if your brother, your uncle, your aunt, etc., if they've invested, like you mentioned earlier, Greg, that could be a more significant portion of their liquid net worth, and that's really important to them. So you can't really treat them all fairly across the board. And even though your biggest capital investor, is this other party, is this institutional party, you actually might have to put more focus on the friends and family round. And I think that is what is so tricky with the friends and family round is it's pulling on your emotional energy in the after hours. Your institutional investor hopefully is only reaching out to you, between 8 and 6 p.m. And you definitely want to get back to them. But then your dad, your brother, your uncle, your aunt are probably calling you 6 p.m. and later. And I think that's really when you say, I'm going to take this call, we can talk for a few minutes about how it's doing now, but I would still love to set up, a more formal conversation with you tomorrow or early next week where I want to show you everything that's going on, to a degree. You don't need to be the most open book possible to them. There is a sense of, you don't want to freak out with everything that's going on in the background. But yeah, even though the institutional investor is going to be, technically your largest capital injection, just think about like your institutional, they have standard reporting, meet that. But this is, it's going to be a lot of emotional energy that you're spending on everybody else. But I think that's why we like the friends and family rounds. Like there is that sense of emotional chaos, emotional intelligence that it requires. This is why we have whole HBO shows, Succession, like based off of working with family, and you really need to navigate those waters with grace. And I don't know. I mean, Nat talked about governance, documentation, but there's a whole other element with family and friends where they're like, yeah, but one time you said that, and you're like, okay, so I don't know. Do you guys have anything to add just about how you deal with the varying, investment levels from various parties?
I would say like you should just treat all shareholders the same. Like it doesn't matter whether they're institutional or family or friends. It goes back to again separating the relationship, right? Like yeah, they're friends and family, but business is business. Like you have to keep in mind that like yes, they are investing in you because they believe in you, and that is somewhat personal. But it goes back to the working personal relationship. Once they choose to invest, they should be treated like other investors, right?
Jay, I'm going to push back just a little bit, just for the sake of the conversation.
Yeah, sure.
It's always so easy to say business is business, right? Hey, we're good friends, but this is my startup. This is like a wholly separate thing than our relationship. But I think the reality, and I think you know this as well, is that business too often is not separated distinctly from personal life. Sometimes they kind of blend into an unhealthy, murky water. So I guess, how do you say business is business and kind of stick to that?
I think it's important to set clear communications. And like I mentioned earlier, having a lawyer really helps because it gives you a third party means to communicate without you getting emotional or saying things that you don't mean, right? Particularly if your business is not going well, right? Every startup, you guys are going to struggle. It's going to be hard. You're going to work late nights. It's going to be sometimes seemingly impossible, or sometimes your product just falls apart and then you get angry at each other, right? Or your investor might get angry at you because they might expect certain numbers, but you're not posting those numbers, right? Obviously, you need to make sure that the relationship is clear communication, and the onus is mostly also on you to make sure you're not emotional, right? If you get emotional, it's more likely that the other person will also be emotional. So it's important for you to do your burden first, right? If the other person does get emotional, right, it's important to also involve third parties, right? If it's difficult to de-escalate, right, you're going to have to confront the situation with the other person, or again, the relationship is going to fray, right? There's no other alternative if the other person's not willing to negotiate with you. So it's really important that you have, again, that clear line of sight into what your goals are and treat them like you would any other institutional investor. I know this sounds somewhat redundant and it doesn't sound like the direct answer to your question, but basically you need to kind of devolve your, like, I guess, push yourself away from the situation, right? And evaluate again, like whether this is a relationship that's can withstand that, right? Because in most cases, I would say it's not, right? Um,
So kind of building off of that, with one of the companies I work with, founder who built $1 billion business before kind of working on their new startup with me, they had, I think, 34 angel kind of small check investors in their startup. And they said that, as that company got big and became $1 billion, company, am I allowed to swear? Is that loud? Okay, I won't. So I should have checked that beforehand. One of the biggest pains in their life was the fact that, they have huge institutional investors, like massive name brands on their cap table that are like, all right, yep, looks good. Thanks for doing all this stuff. And then they have these people that invested 10, 20K when they were worth like $2 million. But now that, even with dilution, it's still a sizable chunk of their company, calling them up every month, and there's 34 of them. And they're like, the biggest mistake I made as like a first time founder was taking money from literally everyone, because most people are a pain blank. So I guess, you guys talk a lot about, you need good lawyers, but it's a bit of a chicken and the egg scenario here. I'm starting a new company. I'm broke. So I'm raising money to not be broke. but I can't pay a lawyer if I don't have money yet. So I guess where do you start with finding a good lawyer? Because very common scenario with startups is you hire a bad lawyer, and then it's a lot more expensive to then get a good lawyer to fix all the work that the bad lawyer did first. So I guess question one, how do you find a good lawyer? And then question two, how do you afford a good lawyer if you don't have money? Open to any of you.
I guess I'll start because I founded my own startup and I had to deal with this. Sometimes it's easy to use things like Upwork. I know that sounds really dumb, but that's what we use, and we got a ton of people who applied. Some from actually pretty good law schools with good like big law backgrounds. So that's a good way to start. If you're not connected, there's also like free legal communities. I know in New York, there's like an Asian American Bar Association. There's also ones for startups as well that I remember we talked to some of them. I forget their names. Before, there also used to be like AI types of lawyers for procedural legal documentation. Like I think Nat mentioned like Carta. There's also like Stripe for some of the LLC setup. There's also used to be Atrium, but it doesn't exist anymore. But there are legal startups that kind of help you through that process, right? So I would mention those first, and then as you get more bespoke, kind of outsourcing that and kind of contacting other like bar associations to kind of get that unmet need. And then eventually you could ask them for a consultation and they'll give you a price. It's not like they're going to charge you right off the bat. So that's how it would start from the lawyer perspective.
Perfect. And I'm going to jump in real quick. If you're a law firm that wants to help startups and you think you're good, feel free to throw that in the chat. Nat, you're a lawyer. How do you tell if another lawyer is good? Because I mean, it's a fun thing I learned about doctors recently is that doctors talk, of course, and not every doctor is actually good apparently, which is hilarious if you really think about it. Apparently doctors like, oh yeah, I know that we went to school together. They're like a bad doctor, but they're still, at a hospital. Lawyers, I'm sure they talk too. They're still, they pass the bar. Of 10 people who pass the bar, how do I tell which lawyer is actually a good lawyer?
There are online resources that you can use to check that, and you can always get, but they're hit or miss. I mean, sometimes people don't like lawyers because they lose a lawsuit, and that's not really fair to the lawyer necessarily. It may just be the lawsuit. People spend a lot of time thinking about, I have a good lawyer and that's going to get me out of stuff or help me with stuff. Reality is, a lot of this should be pretty well established law. And as Jay mentioned, you can get a lot of stuff even online or working with an attorney that will give you some free advice. There are those out there, and without having to hire, a really expensive white shoe law firm to get the basic stuff going. You can always approach that later. If you're going to do a standard Delaware C Corp, which we see a lot, that's the most probably the most well-established type of structure in the U.S. in terms of raising capital for startups. It's relatively well known. You can get a long way with some of those online resources. And also, I would just back up slightly and say consider all of your options, not only with attorneys, but with other, with the whole capital raise. So that may include friends and family. It may include angel groups. It may include alumni groups. It may include accelerators, as we've discussed. I think that at least several of us have been involved with accelerators here, and they often have good connections with attorneys, incubators, universities. These are all resources that you can tap, or even government grants that may or may not be dilutive. That can give you some of that as initial funding. There's crowdfunding, obviously, as well. So make sure you explore all of your options, not only from a legal perspective, but from a capital raise perspective as well. And a lot of those will be able to help provide some of those resources. But getting a good lawyer is great, but really it's the governance up front that you want to make sure you have in place. It shouldn't necessarily be overly complicated. You're not creating a publicly traded company here out of the gate. So just making sure you stick with the standards that are well established, and have somebody who can advise you on some of that stuff would be good, but don't overthink it.
And real quick, Nat, to put you on the spot again, is there like a good question one could ask a lawyer that works with startups to indicate if they kind of get the business or not? Is there like, a certain type of law you could be, hey, do you know much about this? And kind of depending on their answer, you're like, oh yeah, they know what they're talking about versus not. Because I think the problem I think with a lot of this stuff is that law seems very opaque, maybe intentionally. And so as a founder, you have a lot going on, and you're like, yeah, you passed the bar. Like, how can I tell if this type of law versus another lawyer?
Yeah. Again, I'm a non-practicing attorney, so
yeah.
But I passed the bar 20 years ago and practiced for like 6 months. So all of that is to say, but I work with a lot of attorneys here. In our role, again, don't let the tail wag the dog. The legal aspect of it is important, but don't overthink it. And look for those who have worked with early stage companies in your space. That's really as much important as anything. You don't have to work with somebody who's taken a bunch of companies public. You need to work with somebody who's worked with early stage tech businesses, if that's what you're doing, so they understand the dynamics that are important at that stage. So that would be what I would ask. Who have you worked with in this, in this type of business? Who have you helped start up? Are you familiar with this industry and with this stage of business? That's as important as anything.
All right, yeah, perfect. And I guess an important thing to say is you don't have to be married to your law firm. They can be a part of your journey, seed, Series A, then you get a new law firm, a bigger law firm. And I think that's totally a valid answer. Any questions from the audience? Go ahead. I can just repeat it after you say it. Oh, you have a microphone. Perfect.
Thanks. I was looking at it from, I'd be interested to hear from the investor perspective. What are you looking at, or what do you need from a founder when they sit in front of you and ask for money? Do you expect them to have a friends and family round, or do you expect them to have made an investment themselves? Or, like Jay, you said you just started without that. What does it require from a company to start without that?
I guess I can start because I've done both. I would say that it requires on the VC side, especially on earlier stage companies, it depends on how you're positioned, right? If you're doing the search fund, mature business route, it's obviously like you want to see profitability, capability for deal making, right? Are these people going to be able to execute on this strategy that they have, right? So that's for more mature companies. But from a founder perspective, for like, I guess higher growth businesses, right? You need a founder that has high conviction and has given up almost everything for this business, which, I would argue that, college students are more likely to do that, which is why you see a ton of young founders, right? Because they have almost nothing to lose, right? Like they can give up all of their time and energy towards a product and they can just keep going with it. So that's one thing, high conviction. The second thing is also importantly what their goals are for the business, right? It's much easier for you to kind of see a business that's either easily monetizable or has an incredibly grand vision, for example, addressing like a $2 trillion TAM, right? One of those options is obviously to an investor really compelling because if you're thinking about it from probability adjusted weighting, the monetization standpoint is good because they're going to make money soon and you'll get paid back sooner, right? And the business will actually be worth something because it's generating cash. Or the second aspect, which is the moonshot example, right? Yeah, the probability is low, but if it works out, it becomes 30x, right? So that's kind of how the investor is thinking about it. And the final thing I'd say is also, your experience previously running companies, right? And how much expertise you have in the industry. Do you really know this industry that well, right? I mean, everyone knows about Adam Newman raising $1 billion for Flow and everyone gives him crap about it. But I would say that he has previous experience in real estate. So if there's anyone that's going to do it, it's him, right? Which is why Mark Andreessen is 100% okay with investing in him, even if it doesn't work out because he has experience in the industry, right? And I know a lot of people discount that, but it is a valid reason as to why someone would invest. But yeah, Nat, I guess.
Yeah, so it depends on the sector and the stage and the type of investor you're going to. So we tend to look at it from a business perspective. We look at, is there an application to our target market, and then do you have a valid product, and is it able to make money, or is it making money? There's some VCs that look really at the tech, and that's going to be more of that moonshot kind of a thing. That's not the way that we look at it. If somebody says to me, hey, this is a huge TAM and we just need 1% of the market. Well, yeah, but that's hard. But that's really hard. getting 1/10% of a market is generally hard. And so really thinking through that structure and strategy of, okay, where am I today? What do I need to get to? I would like to see not only an experienced founder, but somebody's put their own money in and is close to a working product. You know, if you're asking me for money just based on an idea, it's really hard for me as a business guy and not a tech guy to really fund that. So I want to see something that's up and running or about up and running that I can, you know, test, that's got market validation, whether that's, you know, paid POCs or unpaid POCs, to show that there's a real business opportunity underlying this. That's going to matter to me a whole lot more than $1 trillion TAM and an idea. You know, if I can see a smaller TAM, but real traction in a market that you can go after, where you have a good differentiation, there's a reasonable competitive moat, and you don't have to be the only company out there. You don't have to invent the next iPhone. I often use the example, you know, Walmart wasn't the first dollar store, but it did a pretty good job. You know, it's been reasonably successful. And so, you know, you just need to be able to have a good business strategy that you can attack with reasonable goals, with reasonable amount of money that can get you to that next stage. You don't have to prove to me that you're going to be a trillion, you know, or whatever, $1 billion business. What you have to prove to me is I can get the right business and the right and this amount of investment to get me to stage 2, which is going to be seed stage, an institutional seed stage round, or an A round, or whatever it may be. So how can I get from A to B reasonably with the money that I'm raising, and you know, make me feel good about it?
But Nat, are you like really delving into their existing cap table, or, you know, how much are you taking that into account?
I personally don't care so much as, I mean, if another institutional investor is investing alongside, yeah, there's a little bit of a lemming instinct there, that, you know, that we think they're smart and they think we're smart. Maybe neither of us are smart, but that makes me feel a little bit better, if only because that gives them additional leverage. You know, that gives them additional heft out in the marketplace. But do I care about friends and family? Not really, as long as, you know, I feel like I'm investing X amount, and that has a probability weighted way of getting Y. And again, I'm really not focused necessarily on the exit. Often when we do modeling, we'll say, okay, you know, we're going to buy it in a 8x revenue multiple. We're going to assume that it's going to get diluted down through 2 more rounds. And, you know, what would be an exit multiple, a revenue exit multiple in 5 years that would still allow us to get a target return of 25% or more, something like that. And that's just a basic way of thinking about it. But I really just want to think about, how do I get to that next stage is the most important piece of that 5-year journey.
Got it.
It's perfect. Just a question. Have the microphone. Thanks. So right, is a summary there. There's no real alpha necessarily in having a friends and family round, but it can be harder to get to that minimum viable product where you have customer traction to then justify, Nat, you know, that, hey, look, there is a business here. We have a paying customer. It doesn't matter if you have friends and families on your cap table, but it's obviously hard to build a product with no money. Is that really the short answer of it?
Yeah. I mean, I don't care where it comes from, really, in my opinion. But I'm lucky that I'm, you know, investing later stage than that typically. And so as long as you get there to that valid product that has a good opportunity, and, you know, I would also think about, as you're building that out, as you go into a Series A, you typically want the founders to be sufficiently motivated. So you want them to have 60 or 70% of the cap table remaining, to, you know, as a general rule for that. So that's, again, going back to one of my original points of don't over dilute the cap table, but you got to take in what you need to build a product, because you're never going to, you know, grow, or generally speaking, you won't grow just based on an idea. You need to have a product and customers.
Sorry, Nat. Quick question. Go ahead.
Yeah. So so this is a question. If you're working toward getting a VC round, and but in the process you're saying, okay, I need more gas in the tank, so you go to friends and family or angels, and let's say you do a SAFE where you give a discount, like, you know, say a standard 20% or something like that. Does it matter that if you do that, it's sort of in close proximity time-wise to when you're going to raise the round? Because again, you don't know that you're going to get the round until you get it. In the meantime, you're trying to get, like I said, more gas in the tank. So if you give a discount on that, does that negatively affect raising a subsequent VC round, let's say within like a couple of months of that?
So I'll start. Not really, but a little bit. And that's a terrible answer, I know. But so the bridge rounds, I think, are a good idea, right? So you need to go into that institutional round, you need to show traction. And again, paying customers are good, if not only because it helps you just generate revenue, but it de-risks it. It shows that somebody's willing to pay for this. So how, bridging into that, and you're saying, okay, I'll give a safe or friends and family to get into that. It's not a bad idea. You can do a smaller amount under those circumstances. And so, that helps you preserve not only the valuation question, but the overall dilution question going down the road. It would only really be an issue if you were to raise, a safe, and then, like you said, 30, 60 days later, raise a bigger round. You could put a cap in there, and most of the time I'll ask for a cap. They're not supposed to be valuations, but sometimes it's a little bit of an indicator. So if you were to come in and put a cap and then, or a discount and then raise at a huge valuation that would really give those folks a major advantage to the institutional round, I'm probably not going to want to put in, 15 or a bunch of money where somebody else put in a whole lot less at a much greater discount, which would generally come from the cap. So not that 25% discount, which I might be okay with, especially if it's, 3 or 4, if it helped bridge you to those things that I wanted to see. And there's been a reasonable amount of time passing. But if somebody comes in at a $5 million cap and then, 6 months later or 3 months later, you want to raise at a $20 million pre-money valuation, then I'm going to be a little concerned because they're going to get a pretty sweet deal. And I might think that maybe my valuation shouldn't be quite that high. That makes sense. But overall, good idea. Yeah.
And also build off that from Nat, which is, an investor's job isn't to serve a startup, it's to make money for their investors. And so in a startup's job, right, isn't to serve investors, it's to build a business. And so if you can raise that safe and then maybe get a little bit further and then raise money, you can be able to raise a better valuation, less dilution, all that stuff. Okay.
Yeah.
Are there any questions online?
Yeah, just to follow up on that.
Oh, go ahead.
Sorry.
Go ahead, Nat.
Don't worry so much about round 2. If round 1 is what you need to stay alive, you can figure that bit out later. So
Totally agreed.
All right, so this is the question we have. I have a product coming to market in Q1. I've spoken with friends and family about it, and 3 of them said to reach out when we needed help with the first fulfillment order. In your experience, what would typical offers or interest rates be? I imagine they'd be better than bank ranks in this environment.
you mean interest rate from your investors? Or?
I was gonna ask, is this they're giving you a loan? I'm assuming that's what they're asking here.
Yeah, a loan to fulfill the order, right? Is that what they're asking?
Yeah, that looks to be what it is.
Okay. I mean, I guess I can speak to this because I see the leveraged loan market probably more often than more VC investors do. But typically rates are pretty good for friends and family because they're, tax advantaged. So you can give a loan, even through legally speaking, you can give a loan at probably interest rate of 4 or 5%, and that would be far better than what you would get at a bank, and would 100% be fair just because it's tax advantaged. If you're asking for a specific number, I guess in terms of the amount, that's obviously dependent on your situation, but more generally speaking, in terms of loans from friends and family, again, this legal component comes into question, right? I would 100% paper some type of promissory note or some type of, loan agreement or credit agreement that specifically, is backed by the fulfillment order itself. So that once you actually make the sales, you can pay them back, or, you could talk about structuring in a way that makes it so that, they know that it's going towards the fulfillment order, because there's also an element of trust there, right? That you're going to use it for the fulfillment order.
Yeah. So from my perspective, yeah, I think you're right. Definitely get it booked and have a loan agreement in place. You could tie it directly to that fulfillment order. That's probably best, and for all parties, as opposed to a general unsecured loan or secured loan for that matter. The caveat I would say, that's good for you as a startup. If you can get debt capital that's non-dilutive, go for it. I wouldn't do it myself. I wouldn't want to participate in that, because even then it's still it's an early stage risk. And in my opinion, I'm taking a little bit more than secured debt risk in that case. If you can prove that out, then maybe that's not true. But I'd figure I'm taking at least equity, some form of equity or mezzanine risk, and I'd want sort of equity or subordinated debt kind of return on that. So right now you typically see convertible notes, which are again really for equity purposes, and they're paying 6 to 8%. That's the standard. And so I would personally want at least that, even unless it's really, really for sure and certain and tied to some form of collateral, because startups would need to get friends and family debt for a reason. And that's because they can't get it from a bank or a typical lender. So typically, in my opinion, I would want a better than a rate that's higher than that, because you can't tap the leverage loan market right now.
Yeah, obviously, this is also caveated speaking from the founder perspective. From the founder perspective, you want the biggest discount possible. So I'm just citing, I guess, what would be fair according to like rates, right?
Yep.
And years it's secured. So that's the context for my response. Yeah.
Thanks, guys.
All right. And then this one, Nat, I think might be directed to you. Does Bank Tech invest via safes or convertible debt, or does it only invest such that it receives preferred stock?
We preferred. We are looking at a convertible right now, and have done other types of investments in the past. We are pretty flexible on what we'll invest in, but preferred stock is generally our preferred investment. And it sort of depends on the stage of the business. We often invest, I mentioned post product, usually that's $1 million of ARR or more, but we will in fact entertain safes and convertible debt. I would say though, in terms of preference, it's preferred stock, then convertible debt, then safes, but can do any of the above.
All right. And then it looks like the final question, this is something we touched on a little bit earlier, but again, this kind of addresses the idea of how to figure out how to afford legal fees. So can you give any advice for raising amounts under $100,000 from family and friends and not losing half the money to legal fees?
Yeah, just get online and check out the National Venture Capital Association standard docs and use one of those. I mean, they're pretty well baked. You should have a lawyer as your corporate, but issuing a safe or convertible note for 30 or 40K, you shouldn't need to do. Those are fairly standardized documents. The terms are fairly standardized. Make sure that it all sticks together with your corporate structure. But I wouldn't think you'd need to do that at all, really. So that's my opinion. Obviously, having a lawyer is better than not having a lawyer. But as a general rule, if you're raising 100,000 or less, or 30 or 40, having somebody just review the standard docs that are used in the industry should be fairly sufficient.
It also should be like max, like only a couple hundred to maybe $1,000, because a lawyer would do this in like a couple of hours, right? So it shouldn't take too long.
Yeah, those 30 or 40s are for different stages of businesses, that kind of fee.
Awesome. Do we have any other in-person questions?
Quick question about raising from friends and family. Are there any like tactical provisions you can put into place to, because you have an emotional connection to them, where it's like, some ideas like maybe you only raise a certain amount of money from a friend or a family member, or maybe you wait until there's like a lead investor to set some terms before, you go and take their money, but to like keep them informed about, are there certain like provisions to put into place to kind of de-risk the emotional kind of side of things?
Yeah, I mean, I'll start. I'm sure we all have input on this. If you have a lead, you may not need friends and family, but you may, as was kind of highlighted earlier. The standard, using standardized terms, negotiated at an arm's length kind of fashion, keeping them informed, but it depends on what they're investing in. If they're an equity investor, you have a fiduciary duty, as your board does, to keep everybody informed of what's going on, and you have a duty to those investors. If it's convertible note or safe, it's still different. We should keep everybody informed of what's going on. But those who are not board members or actively engaged in the operation of the business or shouldn't be involved in the day-to-day running of the business. So, it should be fairly established of what their role should be related to their investment and where they are. Whether that's an advisor, sometimes you can have advisory board members, but they're advisors. You can have actual board members, and be careful with those. And they have control over the business if you're a C corporation. And so the tactical ways are related to manage that are related to who they are and the structure that you're using, and that should be, just stick to those as much as you can.
Yeah.
Go ahead, Jay.
Yeah, I would also say that once you actually paper an agreement, whether it's equity, convertible debt, or safe, just as long as you paper something and have something written down that is a legally binding document, that is a contract, that should be sufficient. As long as, again, like what Nat was saying, as long as you know exactly what those terms come with. For example, if it's an equity, right, it's a shareholder. Convertible debt and safes are obviously treated with different preference, right? So knowing investor rights is really crucial in order for you to kind of characterize exactly how you want your friend or family member to kind of stay involved with the business, right? If you don't want involvement, you want to structure it that way. There are also certain types of clauses that you can put in, like, make a structured equity type of instrument, for example, that kind of gives them information on how they should be informed. So it's all, again, dependent on how much you want them to be involved, and you can obviously put that within any type of like shareholder agreement or any type of convertible debt type of agreement. So,
do we have time for one more, Rachel?
Yeah.
All right, perfect. Gentleman right over there.
Hi, this isn't actually a question. It's just an observation about the question about 2 questions ago. My name is Ben Rohn. I actually gave the presentation on raising capital from a legal perspective an hour ago. With respect to raising capital under $100,000, I would definitely not use the NVCA documents. They're too complex and there's too many variables. Either use a safe or common stock. Just raise capital with a simple subscription agreement on common stock. You can do that with minimal amount of legal oversight. But if you try to parse the NVCA documents with or without a lawyer, it's going to take you too much time. So
fair enough. And that was my suggestion. I just agree using standardized docs if you don't want to use the NVCA, but a convertible note should be a 5-page document. So should a safe at this stage. It should not be, something that requires $40,000 worth of your time, to prepare. That shouldn't be what you need. Maybe not the NVCA, but a standardized document, convertible note, a 5-page document, or like you said, common stock. And that's what I would generally expect at this stage, is probably common stock. Preferred stock should be retained for your first institutional investors.
All right, perfect. Thanks, Nat. We have time for quick closing thoughts. Jay, then Sarah, then Nat. 30 seconds, closing thoughts on how difficult, and any things you wish you shared about this process.
I would say you should definitely know, if you're going to start a company or even raise money from friends and family, you should know that your relationship can permanently be destroyed. And that is very important. Like, if you don't trust that your company is going to make it that far, then don't raise money from them. Like, it's much better to preserve that relationship, because at least, like, just more emotionally speaking, it's much more satisfying to have a personal relationship than just ruin it with like a business. And that's my own personal belief. But again, like, you should make sure you have high conviction in your business before, raising money from friends and family, or set clear expectations on what that means, right, in order to avoid breaking the relationship.
Perfect. Sarah?
Yeah, I mean, really just going off of that, similar to how Jay was saying, have high conviction in your business, have it in yourself. If we're human, we're emotional beings. If you know that you can get hot-headed quickly, or you're going to feel overly passionate about your product, which, as a founder, you should, but if that's going to be, to the detriment of relationships with your family and friends, maybe don't go to them. Maybe, your co-founder can go to their family and friends. I guess just, you're going to have to navigate this with grace. We're emotional beings, emotions are crazy things. So just be ready for it. If you don't think that emotionally you can handle it and it's going to be to the detriment of relationships with your family and friends. I mean, those are your people, those are your support system. Don't ruin that for your company. I don't know. You guys might disagree, but don't sever your support system because you need them in other ways too.
Perfect. And Nat?
Yeah, just make sure you think through all your options, set your structure up appropriately, go to the right people and not the wrong people in terms of who's going to be engaged in what ways and how that you're going to need to manage that. And don't ask for money from people who can't afford to lose it. That's a good way to burn bridges.
Yeah, perfect. All right. Thank you all for coming. If you want to reach the panelists, I'm just going to shamelessly throw them. They're all on LinkedIn, so just look up their names. I'm sure they're happy to chat. I'll stick around after if you have any additional questions that we didn't answer, but otherwise, thank you. I'll throw it to Rachel.
Yeah, thank you guys so much for coming.